This again is a very, very good example for a bounce. Like when we have this 1, 2, 3 setup on the higher time frame, it doesn't matter. It's also another plus, but important is that the price moved away from the 200 and the 633. Here we had multiple tops, a range, the price came back down. It did not stop at the 633, but you see when the 633 and the 200 EMA is close together, it will usually stop at one of those. Sometimes it's the 633, sometimes the 200 EMA will bounce off there. It doesn't mean that the trend is going to change or to continue, but at least it will bounce for good. And if you have that on the higher time frame in combination with a 1, 2, 3 coming from the weekly or support, of course then it's even more powerful. As you can see, we already had the uptrend, yes, a range on the weekly, but still this 1, 2, 3 on the weekly chart, also the 36 EMA on that weekly, and then on the daily the pressure was there anyway. In the end, the bounce of the 200, and that resulted into a continuation of this trend. So it's again very, very important that you always remember the 200 and the 633 possible bounce. Okay, I think it's a good example again. And now on the 4-hourly chart, of course, we're still waiting on the daily chart for that 1, 2, 3. We had this first red candle yesterday, but still the day before, but still you can see price decided to create new green candles, and now it's actually just a patience issue. We have to wait. We cannot do much here. On the 4-hourly chart, you see the 36 EMA, higher highs, higher lows. Again, here also the power of the 36 EMA. Price is bouncing there. You have 1, 2, 3, 4 candles getting close to the 36. It cannot break, and then suddenly yesterday I think we saw the first green candle here, if I'm not mistaken, maybe another pair, whatever. You can see the price bounced again on the 36 EMA, moved up about 70 pips. Now for us, only for intraday traders, it's interesting for us. We still have to wait and see on the higher time frame that we get our retracement. Like always, when the price when we see on the higher time frames the price moved up about, I don't know, whatever pips, if you see a big move, more than 3, 4, 5 candles moving in one direction, you don't want to look for new trades in this direction, because you always expect a retracement. So what you want to do is wait for this retracement back to support to the 12 EMA, ideally to the 36. In this case, because we have major resistance, it could be that we get only a smaller retracement back to here, and then you start looking for new trades. That means the price has always to come back at least to the 36 on the next lower time frame. If the price is already moving in one direction and you are not in the trade, you're not just jumping in somewhere. So for instance here, if you wanted to go long, even knowing that this is a very powerful move and it's already moving up a couple of 100 pips or more, so what do? You're not looking for long somewhere up here. You wait for the price always to retrace back to the 36. You know from your higher time frame that the price already moved a lot, right? So you don't try to jump in somewhere. You wait for the retracement, and if you see the price is not breaking the 36, is not retracing, it's not creating a new low and a new lower high, then you wait for the bounce, the green candle, and then you can use a 5-minute chart or even the 1-hourly chart, whatever you think is good enough to take this trade. You can even do the 4-hourly if you don't have major resistance close by, but if you do that, you have to remember that that is not the first 1, 2, 3, but it is the after the crossover. You didn't have great setups, right? But you had the retracement to the 12, one here to the 36, another higher high, and then retracement over to the 12, a big breakout here of resistance. So the price already moved for days up without you on board. And that means if you take a 4-hourly entry here with a stop in this case of about 50 pips, you know it is aggressive, and the reason it's aggressive because it is late. Correct? Does everybody agree with that? Just want to repeat these things because sometimes we forget. Do you all agree? Yes? No? Okay, perfect. That's great. Now when we switch to the next lower time frame, going back, you'll see that even after the trend line break, we didn't really get a setup close after the crossover. So the price just moved up and up and up. And if you don't have enough history like support, here that's the only support line you have. Up here, because the price is too volatile, you don't have 3 touches anywhere. You only have this big 1, 2, 3, and that is a move of about 50 pips with a retracement of about 10, 12. It's not half, it's not 50%, right? So that would be aggressive. And if you do that and you put your stop below here, also a very good example, what happens here, you get stopped out because the price actually wanted to retrace more. And if you check this, it retraced here about 25 pips out of about 50. So that would be the 50% retracement. But here the price moved below the 200, and if you have the stop too close, it's over. It's a late, very steep setup, and it's a very good example for not very good entry. Okay, please, I'm recording this right now because I think we have very good examples we can use here. You have your 4-hourly 1, 2, 3 bounce on the 36. And if you switch immediately to the 5-minute to combine that, you're actually waiting for the break of the 2 to 3 line, of course. Then the green candle appears on the 1-hourly. Here you have the 633 and the 200 in your way. It's a sandwich situation. The price does not give you a 1, 2, 3, only a little tiny retracement, 3 little tiny red candles that would look like this. And then the price breaks up. So if you just feel like it because you saw this 4-hourly 1, 2, 3, then the question would be, could you trade this because the price comes out of the moves over the 633? Yes, of course you could, but that is not a textbook entry at all. Okay, this would be an early entry and aggressive entry. Aggressive because you don't have a setup according to the rules. Yes? No? Everybody agrees, I guess. Okay? So what do? Especially when you're new, you leave that alone. Wait for the next, for the price to move up and then retrace. The problem is the price moved up without retracements to the 36, only touches on the 12. It's too volatile, and when you get your retracement to the 36, it's a steep move with a small retracement of about, 15 pips out of 50. Not even half of the retracement. Usually a nice 1, 2, 3 has a retracement of at least 50% or 60 or 70. Correct? Now, if you think, okay, I still want to take it, I need a reason to trade the long because I have this 4-hourly 1, 2, 3. If you want to do it and put the stop down here, you get stopped out, as I said. The other choice would be you take this retracement 1, 2, 3 here to the 36. You just say, okay, this is not 50%, so 50% would be what, 25 pips, right? So you could put your stop below the 633, which actually is acting as support. Okay, again, that would be an aggressive entry management, because actually what you do is you just use a bigger stop because of your 4-hourly 123 and because you didn't get a smooth, nice setup on the 5-minute chart. And that is something you don't have to do. You can do it if it feels good, but I wouldn't do it if the price moved so much already. Sometimes it makes sense if you just get your 2 to 3 line break coming from the 4-hourly chart. You want to trade and you are late, or you see a setup like this down here somewhere, you say, come on, it's just starting this trend, I want to take it, so I put my stop under the next support level. And it makes sense because you don't have 3 touches, right? Like here you have touches, you can connect the line after your 3 touches, but the line is really far away from your entry here. So what you use is the next important support level, in this case the 633 or the 200 EMA. Okay, I'm recording this, so don't worry, you don't have to remember that. And it is aggressive management, it's not for everybody. Okay, so far, can I go on? Okay. Now, as I said, not one of my choices right now. I want to wait personally for this retracement on the daily chart first. Cable, GBP US dollar. Again, the power of the 36 EMA, price created a lower high. It looked like it wants to break, but in the end the price stayed over the 36 EMA and created a higher point here right now on the chart. It doesn't mean that it will go up forever. It's just telling us and showing us how powerful the 36 EMA is. And it's always wise to wait for a clear break, and then your lower high and lower low, at least on the 1-hourly charts, on the next lower time frame we use for our analysis. Okay, so on the Australian dollar, US dollar, we have support on the 12. It's a 1 to 3 on the daily chart. The shorts work fine for aggressive short traders on the 5-minute chart using this 1-hourly filter, but now the last position probably gets stopped out if you trail your stop. And this is a very important area because we have this daily 1 to 3. It's a long 1 to 3, right? Switch back again for everybody to make sure you see that. And what we want to see is, of course, ideally I want the retracement to the 36. It's not happening right now. And if this 2 to 3 line breaks, which on the 1-hourly chart is a trend line, then we want to look for new setups. It means at least a 1-hourly 1 to 3 over here. This might happen today. Then we can look for a nice long setup. Okay, so far? Now on the 5-minute chart, what you got here after the bounce on support is already a 1 to 3 over the 200 EMA. What you did not have is, let me show you here, a clear break at that level of the 36 on no lower time frame. The price was exactly below the 36 at the 200 EMA on the 1-hourly chart, and only on the 5 minutes above the 200. Sorry for that, give me a second. Okay. So the problem is we have the setup over the 200 EMA, but we see the price being squeezed between the 200 and the 633, and this is our sandwich situation. The problem is that sometimes you see, okay, you measure the distance from the 200 and the 633 and say, okay, it's only 15 pips. If I enter here, according to the rules, I have a stop of about 8, so 10 pips minimum, like always. It's covering only the first lot. Also, I don't have a confirmation for my higher time frames. If you see a setup like this, you'll say, oh, look, it worked great. Let's take it next time, even if the 1 hourly and 4 hourly time frames don't agree. So that's a little trap. That's why I want to talk about this. Yes, sometimes it works, and of course you can do it. It's just aggressive, but over the long run, it's not working that great. I'll tell you right now, because I've done it a million times. You can still make profits with it, but usually when you don't have a confirmation on your higher time frames, meaning if the price did not break the 36 or did not give you the 2 to 3 line break coming from the 4 hourly chart according to the rules, usually the price will end up here, 633, bounce back sometimes, range there, and then in the end go down, hitting a stop. That is just what happens usually. The way you could trade these setups, because they look nice. Look, you have your crossover. You also have a small retracement here to the 12, so you can start counting the 0.1 from here or down here where you have the most touches. It doesn't really matter. Let's move above 20 pips with a retracement of about 12. That is a 50% retracement, right? The price ends up exactly at the 36 and the 200 EMA. You also get a nice 2 to 3 line break candle. It's closing high, and also it's between 0.2 and 0.3 of your 1, 2, 3, which is actually perfect looking on this chart, right? It's easy, nice looking on this chart. So as a setup, it's actually looking nice. The problem we had is that it is close to resistance between levels we usually don't like to trade. And if you know that at least, then it's okay. You know the problem, and if you still take the trade, you know that you have to start taking some profits out here. And if it does not look good again, for instance, if the price breaks the 36 and it looks like it wants to break all support, then you just come out aggressively of the trade. Okay, that's a way to do that. Other than that, you want to look for smooth, nice setup over your 2 to 3 line break, in this case over the 633. Now, of course, when you switch to the lower time frames, now this is your 1 hourly chart, this is your 4 hourly chart. If you draw the lines really closely, because remember, this is a daily 1 to 3. It's not easy to draw these lines on MT4 close to the 36 in the next lower time frame. It would look like this. On the 5 minute chart, a little bit more like this. Here you see the price is actually, this line that is actually between the 200 and the 633 if you do it exactly. Then you have another chance, price retraces back to the 12 EMA, but also back to the 633. Yeah, you have your 633 right there. Then you get your 2 to 3 line break, an entry on this candle which moves higher, and then again you have a stop below 0.3. In this case, you have now also history. You have 2 touches here, and then change of the angle of this line like this. because the price does only retrace back to the 12. The 633 is close by. That's the good reason. And then you get your entry. Still, you have to place a stop below the line. And then you can start targeting your first 10 and 20 pips. Okay, this is again, as I said, a difficult, I would say, and tricky example where you don't have a clear 2 to 3 line break and the price sits between the 200 and the 633, but having a good setup, 1, 2, 3 setup all in all. Okay, does this help you as an example to understand the differences? I'm recording this right now, so we have a new good video that you can use. Okay, because I know sometimes you wait and you sit there and then you get your setup and it looks really good, and then you do your top-down approach and you say, oh man, it's not that great, right? Because I don't have clear trend line breaks, I don't know what to do. So again, if you don't feel good about it, you just leave it alone, you don't touch it, that's it. If you still want to take it, the trade, then you have to also manage it a little bit aggressive. Watch out for quick bounces and come out of the trade, okay, in case it doesn't go your way, in case you don't get your higher highs and higher lows quickly anymore. Okay, also here the same story. Ideally we want to see a 1 hourly 1, 2, 3 and then a 2 to 3 line break, and then we can look for longs. You can use the 1 hourly chart, of course, or the 4 hourly, and then target your highs on this chart. This is one of the, as I told you, one of the biggest swing trades I've ever seen from a student. This position is open for over a year, and when the price retraced to down here after over 3,000 pips, you saw, I think, the video and the email. The question was like, what should I do now? He took out half of the remaining position and left one position open. And if you look at it, since yesterday, price moved up another 200 points. So it was not a bad decision to keep the long open, right? The higher time frames are just so powerful, and if the price creates higher highs, higher lows, and still wants to move up and have no reason for anybody to come out of a really good swing position. Look at that. It moved lower. It looked like some shorts again. There were some intraday setups, even on the 1 hourly chart. We had 1, 2, 3s, and price moved down about 60 pips. So for intraday traders, it was 2 lots out. But then this happened. That means the remaining position had to be managed over the line, and then you got your 1, 2, 3 over there yesterday. Now that was a big break during, I think, Asian session, probably caused by news. I don't know, I was sleeping. And but if you have that swing long coming from a weekly chart, it needs patience. And as you see, it still looks long, no reason to come out. So there was no setup on a lower time frame to enter this trade, and also you couldn't take this trade because your 2 to 3 line break candle, that one was just way too big, right? It closed over 0.2 on your 1, 2, 3, and again a very good example for an entry we usually don't take because it is too big, meaning you have to use a bigger stop of over 100 pips on the 1 hourly chart, and I don't think it's worth it right now after a big move like that. I'm not saying it cannot move up to here, it can, but wait for an entry, maybe for next 1, 2, 3 setup, and then for 5-minute entry. Yes, if I check the 5-minute chart, you'll see there is no entry. Not close to the break. Look, price moved down. You had this range. Again, one red candle, and then suddenly it moved up like this. Okay, and that happens sometimes. So yes, aggressively, like some of you do, probably Edward likes these things, trying to just take advantage of the sudden reverse, but you get your lower high and then retracement to the 36, and again here it's an example of a steep setup, price moving up 100 pips, it retraced about 40 pips. Yeah, it's almost 50% retracement. The whole setup is just too steep, and then the retracement is not smooth. It's like a lower high and another lower high, and suddenly these setups I personally don't like much. Okay, it's not what I would like to see, but on the 5-minute chart there's not much damage. If you try it out, you get your first high low here, green candle, then you can try the entry with a stop below here. It's not too big. I mean, it's about what, 25 pip stop. Right now you would probably would have taken out one lot. That's about it. It's just nicer if you usually get your normal setup somewhere here, 1, 2, 3 here, with a nice retracement. Price is still close to the 200 EMA, and then you get your first and second lots out easy. But it didn't happen, so that's what you are looking for. You want to avoid that. A very good example of a bounce trade, and again the same story. If the price moves and it's trendy and then it comes back, usually if it's touching the 200 or 633 for the first time after a bigger move, after you see the price moving far away, then it will end up in a bounce. And that's what happened here twice, 3 times already. GBPCHF came back, hit the 200 and almost by the pip, and retraced 100 plus pips, stopped at the 36, came back down, bounced again on the 200 EMA. So that's not the first time here now, but what happens is it's ranging between the 200 and the 36 EMA right now. It bounced even a third time. That is telling us that right now this pair or the price does not want to go anywhere. And if you check out your 1 hourly chart, you'll see that here's your 633, down here's your 200 EMA coming from the 4 hourly chart. And what is that? And just ignore, like always, the spikes. It is a bounce, another bounce, and up here in this area you have a lot of touches also. So we have resistance, 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 resistance. This is now a 1 hourly range. Yes? No? Does everybody agree? And now that we switch to the 1 hourly chart, you also see the price is moving away from the 200. Bounced once a little bit, 40 pips, came back down, and when it hit the 200 EMA again bounced 50 pips. And the power of the 200 and 633 is just incredible. And you can also trade off these EMAs with a good top-down approach, making some good extra pips every time. But that's not for today. And look at that. Now it's reaching the 200 EMA again, and we cannot really do anything, right? If we are short, it's at resistance right now, so okay, we don't come out right now. Maybe it wants to go down and break support, okay? And if it does, if it comes back down, we'll probably bounce here again. At some point, the price will come out, and it will give us this 1, 2, 3, or this 1, 2, 3 below support. If that happens, I stay in with my short, of course. If that happens, I will come out of the short and start focusing again on longs, because daily charts are telling me that this is, yes, a range and yes, bounces, but still higher highs, higher lows, still an uptrend on this daily chart. Do you all agree with that? It's really that simple. It's just about understanding what the market does, and you just apply the rules, everything you know to trade. If you don't understand what you see on the chart, you just walk away and look for a setup on a different pair. It's also a good example. You have your 2 to 3 line break coming from the higher time frame. You see the price is breaking, is bouncing a little bit on the 200, but actually moving below both. And then the 633 is acting as resistance. So the price is trying to reach the 36 almost by 1.5 pips. It stopped and then it moved immediately lower. So you have a weird looking 1, 2, 3. You will see that often because these charts, this happens often when you see a 2 to 3 line break or trend line break and the price moves below that line or this trend line, then it will retrace only to the next level it finds, which is usually the 633, the 200, or the 36. If the 36 is too far away, only to the 633 sometimes, like this, like in this example. It does not look nice and smooth. It looks a little bit steep here, and then you get your 2 to 3 line break, and you can see the 2 to 3 line break, and this candle is really close to 0.2 on your 1, 2, 3. So you want to take an entry somewhere here and put a stop over there. That's 13 pips plus the spread. Okay, it's an aggressive setup because it does not look nice, but it is below the 2 to 3 line break. And the good thing about this example is the history you have. 1, 2, 3, 4 touches. Okay, that's a reason to take again an aggressive and not that great looking 1, 2, 3. Now, as I said, I'm usually watching the charts every 4 hours, and that means not more than 4 or 5 times a day. And because I have my lines ready and I know what I'm looking for, it takes me 5 minutes. So now that I'm expecting a retracement back to the 36 ideally, and if I want to take this 1 hourly 1, 2, 3, I know that it needs at least in 5 minutes this candle will close, right? It needs at least 1 or 2 hours before the price comes back and hits the 36 CMA, and we'll probably need another hour before I get my 2 to 3 line break candle. So nothing here will happen out of experience in less than 3 hours. Do you agree with that so far? And also probably not before US Open again. So there's no need for me to stay here and wait to see the price moving down. I just come back in 3 hours and watch. And sometimes, yes, for some reason the price decided to move faster and break out, and I will lose or will miss out a trade. That happens, but not very often, because usually it takes about 3-4 hours minimum if the price is already moving in one direction before it retraces and gives you a break, a 2 to 3 line break, for instance. Okay, so I don't spend personally more than maybe an hour a day watching charts. It doesn't mean that you cannot do it otherwise. You just ask me what I'm doing, and that's what I'm doing right now. Like 5-6 years ago, still I was trading all day long, especially when the markets were very, very volatile. 2007, 8, 9. Sometimes I was sitting here with friends 10 hours, 12 hours, eyes getting really red, you know what I mean? Could not focus on anything anymore, even waking up at night trying to watch out and looking for new setups, because you just wanted to trade everything you got. And that is something that will help you getting a lot of experience. But it is also, right now, I think, a waste of time, especially when you have a family and you want to do other things during the day also. Okay. Yes, that's how you train your eye, and that is where you get this really good feeling for the market. But I'm talking about lower time frames, right? You get a really good feeling about trading on lower time frames, aggressive trading, bounce trading, and everything. For swing trading, you just need to train your eye on the 4-hourly daily chart. You don't need to train it on the 5-minute chart and sit there all day long. That's the great thing about swing trading. Also, what I figured out over time is that I make the same amount of pips, probably more, when I do swing trading compared to day trading. When I sit longer, I'm looking for more trades, also losing more trades than compared to swing trading. So you have to manage more trades. In the end, you end up doing the same amount of profits compared to swing trading. The great thing about swing trading is you don't have to spend a lot of time in front of the charts. That's why I prefer it right now. Probably also, of course, much less stress. And 7-8 years ago, for me, it was like really a sport. I really liked the action a lot. Now, not that much anymore. Probably I'm getting older, I guess. But I always advise traders to focus on swing trading, because it's a relaxing way to trade. Yes, sometimes you have to wait much longer before you get setups. It can be a little bit frustrating if you're not used to it, but if you are in a very good, powerful swing trade and it goes your way for days or even for weeks, you will really start enjoying it. Okay? Yes, of course I do that. I do that as well. Yeah, if I get the chance, I do it. We also do that in the live room very often. It's just that lately we don't get many opportunities during our sessions. So what I will do, in about 2 weeks, I will change the morning sessions. I will do it in the evening, and maybe we get more chances during the US session, late US session, so we can practice a little bit more. I don't know. I mean, Vasily, why not exciting? I mean, it should be exciting. As I said, often when people say you don't have to feel anything, you have to trade without, you have to be ice cold, and you have to just trade without emotions. I just disagree with all of that, because you have to have passion for trading. You have to love it, right? If love and passion is also an emotion, and without that, I don't see the reason to trade, because you say, okay, it's about the money. You won't make any money in trading if you don't like it, if you don't have passion for it. I don't believe anything else. Yeah, you have to like it. Otherwise, it's really not that easy to make profit, especially with Forex. It's a different thing if you have, I don't know, 100 stocks, you buy them somewhere cheap and you just leave or forget about them for 20 years, just hoping that some of them will make profits, and probably some will. That's a different way of trading. We are talking about trading the Forex market, being involved on charts, and with the charts and with the markets almost every day. That's a different thing. Yeah, exactly. Yeah, with stocks, at least in different countries, it doesn't work. Like if you live in Greece, for instance, for sure it doesn't work right now, but it will probably, everything comes around eventually, right? So we have to see what happens. Yeah, that's what I do. That's how I see things. I hope that's helpful also. Let's look at some other pairs. A good example again on the Euro New Zealand dollar 4-hourly chart. Bottom formation, trend line break, 36 EMA breaks. Price moves up about 340 pips. And it touches the 633 again for the first time. And what happens here? We have 1, 2, 3, 4, 5, 6 candles, and it is bouncing. Okay, so first rate candle and then bouncing. So you can use the candle if you want to take a bounce trade, or you just draw your line close to your Heikin-Ashi bodies. Switch to the next lower time frame, lower high here, and start looking for aggressive shorts. Of course, it's aggressive now. On the 5-minute chart, you see when the price moved after this Heikin-Ashi trend line break and the bounce on the 633, the only thing you got here was your 1, 2, 3 below here. That's a move of about 30 pips with a retracement of about 20 pips, more than 50%. Price goes back to the 200 and this 36. 2 to 3 line break, clear entries. You also have your trend line break here and also a small one here. And you have resistance and 3 touches. Most important, the 3 touches that confirm the pressure to the downside. I think it's also a very good example for a setup below the 200 EMA, resistance, trend line breaks, small support line breaks here, and then price moving down. If you check the 1-hourly chart, the price hit the 200 EMA. And as I said, it doesn't matter what time frame, if the price hits the 200 or 633 for the first time after a bigger move, it could be a bounce. And because the 4-hourly chart looks like a big 1, 2, 3, we have to watch out now, see if that's a bounce. Could be that the price moves a little bit lower, then retrace it. It doesn't mean that it has to touch it by the pip. Sometimes it stops a couple of pips earlier, sometimes it's touching it by the pip, and sometimes it's breaking it and then retracing. Okay? So you watch out closely on the 5-minute chart. The only way to trade a bounce trade, the touch on the 200, would be wait for the touch on the higher time frame, then wait for your 1, 2, 3 over the 36 to take a long. An aggressive way would be just the first green candle, but that's really aggressive and we don't have to do that right now. It's about 1, 2, 3's retracements and then placing the correct order, placing the stop at the correct place there, and then just manage the trade. You really don't change anything. You just have different situations. You have to get used to it and decide if you want to take the trades or not. But if you do the top-down approach correctly, you will see it's really not that difficult. You get used to it at some point, and then with a little bit of experience, it's easy for everybody.